Understanding rate of return, RoR. A rate of return, RoR, is a crucial concept in the realm of investment analysis, serving as a measure of an investment's profitability over a specific period. By expressing the total gain or loss from investments as a percentage of the initial amount invested, RoR helps investors to assess the performance and attractiveness of various investment opportunities. Key takeaways. Investment measurement. RoR is a primary metric used to measure the profit or loss of investments over time. Versatile application. It can be applied to an array of assets, including stocks, bonds, real estate, and collectibles. Nominal versus real. The basic RoR does not account for inflation and is categorized as nominal. To account for inflation, one can calculate the real rate of return. Incorporating time value. The internal rate of return, IRR, calculation integrates the concept of the time value of money. What is rate of return? RoR can be computed for any investment, allowing investors to evaluate past performance and predict future returns. It is particularly beneficial when comparing different investments or gauging the effectiveness of investment strategies. Investors usually set a benchmark for the required rate of return before initiating any investment. The RoR formula. The formula for calculating RoR is straightforward. Backslash text, rate of return, equals left, frac, text, current value, text, initial value, text, initial value, right, times 100. This formula allows investors to quickly determine the percentage change in the value of their investment. Example of RoR calculation. Consider an investor who purchases a stock at $60 per share. After holding it for 5 years, during which they earn an additional $10 in dividends, the investor sells the stock for $80 per share. 1. Gain from sale, $80 to $60 equals $20. 2. Total gain, including dividends $20 plus $10 equals $30. 3. RoR left, frac, 30, 60, right, times 100 equals 50 %. This indicates a robust investment performance. RoR in different types of investments. Stocks and bonds. Calculating RoR can vary slightly between different asset types. For example, consider a bond investment versus a stock investment. Stock investment. If an investor buys a stock for $60, earns $10 in dividends, and sells it for $80, their total gain is $30, yielding an RoR of 50%. Bond investment. If someone purchases a $1,000 par value bond that pays 5% interest annually. After 1 year, they receive $50 in interest, decide to sell the bond for $1,100 after 1 year, resulting in a total gain of $150, $100 from the sale and the $50 in interest. The RoR would be text, RoR equals frac, 150, 1000, times 100 equals 15 %. Real rate of return versus nominal rate of return. While nominal RoR is useful, it does not account for inflation or changes in the purchasing power of money. Nominal rate of return reflects the raw growth of an investment. Real rate of return adjusts nominal returns to reflect inflation. It is useful for understanding the true growth of your purchasing power. To calculate the real rate of return, you can use the following formula. Text, real rate of return, equals frac, 1 plus text, nominal rate, 1 plus text, inflation rate, 1. Compound annual growth rate, CAGR. The CAGR is particularly important when evaluating investments over multiple years. It represents the mean annual growth rate of an investment, accounting for the effect of compounding. The formula for CAGR is text, CAGR equals \left, \frac, \text, ending value, \text, beginning value, \right, caret, \frac, 1, n, 1. Where n is the number of years. Discounted cash flow and internal rate of return. Investors often prefer to consider the time value of money by calculating discounted cash flows, DCF, and the internal rate of return, IRR. Discounted cash flow, DCF, calculates the present value of expected future cash flows, which helps determine whether an investment is worthwhile. Internal rate of return, IRR, the discount rate that results in a net present value of 0. It provides insights into an investment's profitability by comparing different investment opportunities on a similar time basis. RoR versus other investment metrics. Other benchmarks like IRR and CAGR can serve as valuable alternatives to understand investment performance, especially when considering complex investment scenarios where cash flows are not consistent. Challenges with rate of return. Despite its usefulness, RoR has several limitations. Ignoring cash flow timing, it does not value the timing of cash flows, which can be critical for future cash inflows or withdrawals. Assuming constant returns, the calculation often assumes steady returns, which is unrealistic for most investments grappling with market volatility. Risk assessment. RoR does not provide any insight into the risks associated with an investment, making it imperative to pair this metric with an analysis of volatility and asset risk. Conclusion. In summary, the rate of return, RoR, is a vital metric for assessing the performance of investments, allowing investors to measure net gains or losses over a specific timeframe. While RoR is a straightforward calculation, it is essential to consider factors such as inflation, the time value of money, and cash flow timing for a more complete investment analysis. Other metrics like IRR and CAGR provide valuable insights into the nature and profitability of an investment, making a comprehensive understanding of these metrics indispensable for effective financial planning and decision-making.